Hello, everyone. Welcome to this latest edition of Markets Monthly. My name is Gary Quinzel, Vice President of Portfolio Consulting at Wealth Enhancement, and I'm joined today, as always, by my colleague Aya Yoshioka, our Portfolio Consulting Director and Senior Investment Strategist. With that, let's go ahead and dive in and talk about what's new in the latest in the markets. Starting, as we always do, with perspectives and insights from the roundtable, the markets have been overall very resilient. The one big takeaway, as Aya is going to talk about in a few slides, is how we are seeing some narrowing breadth, and that it hasn't taken away from the overall performance that we've noticed. Overall, we've seen pretty solid numbers coming across as we monitor the major indices, but when we do start seeing that narrowing leadership, particularly as we're kind of used to in those large cap technology stocks, one starts to wonder about the longevity of this rally. And so we'll talk a little bit about where we think this is going, and actually we're starting to see some little bit of a rotation. It's not going to show up in some of the data that we're going to show to you because we have our performance data through the end of July, but we're actually seeing some interesting developments as some of the latest data from coming out of the Fed and some of the indications about potential rate cuts. We are seeing a little bit of rotation in the small caps over the last couple of weeks. So it's quite interesting. But as the slide indicates, generally speaking, this year we have seen some narrowing breadth. It has been one of the bigger takeaways. And another really key observation is the fact that cross-asset valuations, whether you're looking at equities, alternative assets like crypto or gold, or many other, are all indicating that we are feeling more like we're in that late cycle environment. So one, again, has to wonder about the duration longevity of this market. It feels good right now. There's a lot of positive signals, especially from the One Big Beautiful Bill Act. That's been, again, just another catalyst helping the markets out. And we're seeing a little relief from the impacts of tariffs. Yet the valuation story has not gone away, and in some cases it continues to be more elevated, and so we have to be a little bit concerned from a valuation standpoint. And lastly, we're going to talk a little bit about economic data. And so whether you're looking at leading indicators or hard data or soft data, all of that does paint a picture that's a little more concerning. And as Fed Chief Jerome Powell talked about recently at the Jackson Hole Symposium, the overall picture does lead us to think that we're gearing up for another rate cut, but it would be a rate cut not for the right reasons, and possibly because we're seeing potentially softer data and a potential uptick in unemployment. So we'll talk about that in our economic slide. But before we do that, we're going to start by talking about what happened in the markets over the last month and the last couple of days. So with that, I'll hand it over to Aya.
Thanks, Gary. So this is the performance chart through the end of July. And I think when we look at this chart, what really stands out are those developed international and emerging market returns, right? We're seeing close to 18% returns in those markets, and they've really beaten the US equity market, which hasn't happened in quite some time. I think the other thing that we notice when we look at this is that the bar over to the right-hand side, that 9.4% for a global 60/40 portfolio, has beaten 100% allocation to the S&P 500. So from a risk-adjusted standpoint, that global 60/40 portfolio really is doing an astounding job so far in 2025. I think one of the things that we are also focused on is that small cap section. I mean, the bars are really small there, and you're not seeing the participation that you typically would see out of small caps probably later in the cycle as we normally do. But we've just seen some issues within that small cap universe. Companies are staying private for much longer. They're becoming public at much bigger valuations and are becoming public at large cap valuations versus at those small cap valuations. And so just the sheer mix of the universe in small cap land has just been different than what we've seen over the long history of small caps. And then when it comes to fixed income, fixed income is generating solid yields. Yes, interest rates are likely to come down over the next 6 to 12 months, However, you're getting really good yields, and you're seeing that in the total returns here, because the starting yield does matter when it comes to the total return that you're going to get out of fixed income. And you're seeing, close to 4% returns on a year-to-date basis for the U.S. ag, and you're seeing, almost 6% returns there for the global ag. So really solid returns across most markets here when we look at all asset classes. And then if you go to the next slide, we're going to dive in a little bit to what we're seeing in the US large cap space. And this is a great chart that, great table that says, when you really look at it and you think, what has really driven the returns? We all hear about the Mag 7 and tech stocks being really the engine that has driven the US equity markets. And that was true in July. You see that, tech was up 5.2% during the month of July. But when you look at the year-to-date numbers, really the industrial sector has been a strong performer from that standpoint. And tech and communication services are sort of neck and neck around 14%. And then a defensive sector, such as utilities, is up almost 15%. And the one thing that I will say that all of these sectors have in common is that artificial intelligence trade and that theme that really comes across in tech. It's also being powered by a lot of industrial technology, whether it's turbines and whatnot, that really power that electrification at the data centers, and then the electricity itself at the utilities. So a lot of this is tied to that one thematic. And so that is a little bit of a concern as well when we look at just the growth that we've seen across different industries. And despite the broadening out of the theme per se, it really is a narrowing that is really focused on just that one thematic. If you go to the next slide, I think the other thing that we want to point out here, which is a great chart that shows US versus international. So the white line at the bottom there, that's been the US equity, the S&P 500 returns, the path of returns throughout 2025. And the red line there is the emerging markets, and the blue line is the IFA, which is the international developed stock market. And you can see what I spoke about earlier, the international stocks, anything outside the US has actually done better so far. And a lot of that came at the beginning of the year, especially during that tariff turmoil in the first quarter in March and April. But the overall stock markets, regardless of whether it's the US, international, or emerging markets, have continued to do well sort of post that April timeframe. And with that, I'm going to turn it back to you, Gary.
Thanks, Aya. Yeah, great updates. And I think you hit it spot on when you talked about how really since the middle of February through the end of April, or midpoint of April, the market low, that was that big divergence. If you were actually to start those returns in April onward, it's been actually pretty even. And if you take out the currency impact, they're even more even. So while it's been a really interesting play, it's really uncertain right now what is going to happen next, because so much of it depends upon the data, as it always does. It always depends upon earnings, and earnings, of course, are driven by the macro situation. So with that, let's dive in. Let's talk about, I think, the biggest indicator that we should all be paying attention to right now. That is the payrolls. What we have here is the most recently Bureau of Labor Statistics monthly payrolls. And it's not just the initial payrolls that are initially announced, that's what gets all the headlines, but many don't pay attention to the revisions of previous months. And every single time they come out with a new monthly payrolls, they revise the past 2 months. And sometimes it's higher, most often it's lower. And so if you combine the May and the June revision, overall payrolls were revised lower by almost 260,000 jobs. And other than the recent pandemic in 2020, that's the largest revision going all the way back to the late 1970s. So it really is a significant indicator when you take that, coupled with the fact that the July report also came in a little softer than expected, only 73,000 jobs. So if I were to draw out this chart and look at it on a much longer scale, you would start to see it coming down. And that is something that, of course, I mentioned it earlier, Fed Chief Powell is paying a lot of attention to as they start handling that dual mandate and thinking about, okay, what is inflation doing? What are payrolls doing? They're starting to get a little more concerned to the downside risk on the labor side. And so the other thing, if you look at historically, when you start seeing more significant shifts in labor data, a lot of that is because companies are slow to report because they're trying to figure out what's happening with their own situation. There's a lot of studies and evidence that indicates when you do start seeing more delayed responses and bigger negative responses, that can signal an upcoming turning point. So it doesn't always necessarily mean that we're about to hit a recession or a significant downturn, but it is, one of those signal points that we want to pay attention to, because it was historically larger than normal. And so we should all be paying attention to that. And that has helped change the narrative. And if you look at the odds of a rate cut at the upcoming September meeting, it went from around 60% of a chance of a rate cut up to around 87% currently. And as I always mention, those numbers, those probabilities do change on a minute-to-minute basis, so we want to take them with a grain of salt. But the fact that it went so much in that direction, and all the other economic data, which I'll show you on the next page, indicate a picture that simply suggests that we're seeing more softening data. And so, as always, we know that some of this is really hard to read on a small screen. You really have to break out your reading glasses here. But some of the things that stand out to me, definitely consumer confidence, some of the household income expectation, that's some of the soft data that we talk about, really indicates how consumers are feeling with their wallets and their income expectations. How are their expectations about having a job 6 months from now? That has continued to be soft. And if we look at things like, some of the ISM data, that's the manufacturing side of things, again, points to somewhat of a weaker situation. And if we look at some of the more aggregated leading economic indicators, which pull in a lot of other economic data altogether, that again certainly paints a softer than average picture. So it doesn't necessarily mean the economy is falling off a cliff, because we continue to see strong corporate earnings driven by the AI tailwind and increased productivity, which has overall been strong. But what we do definitely notice is that things like new building permits have been softer, and consumers are feeling a little more worried because the payroll, the labor situation doesn't seem to be getting better, it seems to be weakening, and inflation is still with us. And so when we jump to the next slide, we'll show you a slide that we've shown many iterations of this over the previous months, but it warrants some revisiting. If you look at the fact that the year-over-year number, of course, CPI has ticked higher, it's quite subtle, but it does represent the dilemma that the Fed is in, because they have this dual mandate. They're starting to get worried about the weakening labor data, which of course ties into slower than average growth, but at the same time, inflation isn't getting anywhere closer to that 2% mandate that we've talked about so much. Big question, of course, is does that 2% really matter? Is this yet just another blip in the radar? But overall, what we are seeing is certain things, whether it's autos or other big ticket items, are starting to show signs that there's certain things, certain impacts from the tariffs are just not going away. And so we're starting to see, when we break it down into a lot of the core elements that drive CPI, that inflation is still with us. And so we have to take that into consideration when we think about what the Fed's next moves are. And I know there's a lot of policy implications that are influencing the Fed's next move, but the back and forth, the push and pull between inflation and labor data ultimately is going to be what drives rates. And it does look like we're going to see that next move down. But with that, I'm going to hand it back to Aya. She's going to talk about some roundtable perspectives, which will tie into our forward-looking outlook for the remainder of the year.
Thanks, Gary. Definitely on that inflation front, one of the things that I think was really eye-opening last month was the producer price index. So far, the CPI remained relatively tame, but that producer price index really popped. And I think it signals that perhaps corporations have taken the first brunt of the hit when it comes to tariffs, but then we'll have to wait and see whether or not that really truly does get passed on to the consumer going forward. And I think that's one of the concerns that the market really has. And I think because of that, you're seeing this uncertainty, right? And the uncertainty here is in the white line you see, and then gold has been very correlated to the uncertainty index. And so when uncertainty becomes high, the price of gold has risen in conjunction with that, as people get a little bit more risk averse, right? We want to make sure that you're diversified and protecting what you own and what you have. And there's a lot of uncertainty out there regarding the Fed's next move, where inflation goes, where does the economy go, geopolitics. We've had all sorts of different levels of uncertainty to deal with over the last few years. And so that has certainly seen a rise in the last few years, especially post the pandemic, and in this higher inflation environment. So we've seen gold really take on sort of new highs this year. If you go to the next slide. This sort of then leads to the everything bubble. I love this in that, one of the things that you learn early on is valuation matters, but at the same time, valuation is a horrible timing tool. So, valuation, when you look across US equities and even fixed income, you can see that things are a little expensive. And, whether you're paying up for quality, which, most certainly a lot of investors have done, having ownership in high quality companies that have solid balance sheets is a prudent move to do. However, they've become very crowded and very expensive at the same time. On the flip side, buying value and cheap stocks has been tough because sometimes cheap stocks get cheaper. And so it makes it difficult to find the really cheap, inexpensive diamond in the rough when everything has become so expensive. And even on the fixed income side, when you think about where spreads are, those corporate spreads relative to treasuries, they've narrowed quite a bit and they're pretty tight, which means that you're not getting paid anything extra to take on that corporate credit risk. So, we do monitor a lot of this. And I think, again, where do you hide when everything is this expensive? That's the question that I think we get probably most of all. And I think my answer to everything has been to diversify, right? Just to make sure that you're not concentrated in any one area, because you just don't know exactly where the shoe is going to drop.
So Aya, what I think is really interesting, sorry to jump in, what I think is really interesting about this chart is you can't put, it would be too much to put all the data on this table to demonstrate where you get, how do you determine or define valuation. But if you actually look at the methodologies, it's actually quite interesting. And there's so many different methods of how you value an equity. Is it versus cash flow? Is it versus a dividend? How do you value a bond? Is it versus another asset class? Is it based upon a spread relative to a risk-free asset? And then it gets even more challenging when you get into things like alternatives and gold. And it has no income, but there's historical ways you can compare it to real yields. And Bitcoin, of course, is the most challenging. And so it's still a new asset. Many would say it's impossible to evaluate, but others look at things like market value to realize value. And I'm sure there's folks out there that have their own ways of methodologies and interpretations of how to look at valuations. And as you started this off by saying, there is no perfect way to utilize this from a timing perspective, but it is really valuable when you think about it in aggregate, how all of these things interplay, and you're starting to see more and more investors look at these things in addition to equities and fixed income and start piecing in gold and Bitcoin and other alternatives as they're thinking about where should I put my money. So thanks for bringing it up. I thought it was really interesting.
No, absolutely. And I think, again, it just goes to, people looking to diversify, right? I think that everybody knows that things are a little expensive. So where do I go to diversify? If you go to the next slide, I think this was a great chart that showcases sort of the bull and bear cases across all the different asset classes, right? Whether it's US equities, international equities, fixed income, or commodities, there's always a positive case to say, you know what? US equities can continue to march on. I think there's been plenty of data that says, buying at new all-time highs is not a bad strategy. 1 year later, you're typically seeing positive returns. And so, is the US equity market expensive? Yes. Is it a terrible time to buy? Perhaps. Right? It's really difficult to time. And then I think on the bear case, you could also argue that there's slowing economic data, and at some point this has to impact corporations, right? There's been so much concentration in these tech companies that maybe it's been hidden from plain sight just because the cyclical companies, those companies that are more impacted by interest rate movements and more impacted by the ups and downs of the economy, are just smaller in terms of the overall S&P 500's weight. That doesn't mean that the impact of the economy has completely gone away, right? And if anything, perhaps it's something that impacts these Mag 7 stocks or NVIDIA specifically that really, hits the S&P 500 more than anything else. On the international side, yes, they've had such a fantastic year so far this year. I think that could potentially keep going. That valuation differential between international stocks and US stocks is not as large as it once was, but it's still there. That gap is still there. And you could argue that, they can meet in the middle somewhere, right? International equities can continue to go up a little bit and close that valuation gap. But on the flip side, international stocks may not be as, strong from a balance sheet standpoint, or they may not have that growth from a tech standpoint that some of the US companies have. And then when it comes to bonds and fixed income, you are getting solid yields on fixed income. Again, as I mentioned, that income that we're finally getting after a decade plus of having sub 1% yields is really, really nice. On the flip side, there's a lot of concern about the trajectory of US debt and treasuries and how that's going to reflect the price and yield just over the long term. Having a sort of greater debt to GDP ratio could be problematic, right? You're going to need much more treasury supply in order to fund the US government. And so that tends to be a little bit of a concern, but on the flip side, that means you're going to get a little bit of a higher yield. So that supply demand dynamic is something that we continue to watch on the fixed income side. And then when it comes to commodities, it really does depend on the specific commodity you're talking about. As we mentioned, gold, tied to a lot of uncertainty. It's done really well so far. But on the flip side, oil, which is tied to a little bit more economic activity, that one hasn't done as well this year, just given some of those late cycle signals that we're seeing. So it really depends on where you're looking, but there is a hedge somewhere. There is diversification across all of these asset classes. And I think that's the message that I want everybody to take home.
Thanks, Aya. Great summary. And I think that leads us well into our outlook and opportunities, the way we close things up here. So as we talked about, I think we need to be very cognizant of where valuations lie, but it doesn't necessarily tell us where markets are going in the next few months or even the next year. So we want to be cognizant of that, and we want to be a little more selective. And so we started off by saying it's a great time to be internationally diversified. The international 60/40 is doing better, or as good, if not better, than the US market right now. So it's a great anecdote, something that we should all be taking advantage of, and something that we think can actually continue for the foreseeing months. But one of the concerns we have to be very mindful of is the fact that labor data is softening. Slower growth could be problematic, and what we're going to be watching for is whether or not that creeps its way into corporate earnings, because ultimately that's what's going to be driving the markets. If you have valuations that are already stretched, you see the earnings side come down, that could mean a market correction. So, people often say we're overdue for a correction. I really don't know what that means. That's a very, ambiguous term, but the challenge would be, of course, if we saw earnings come down. And so we'll keep our eyes on that. And of course, there's always concerns around divergences in policy, and so differences in rate cutting between Europe and Japan and elsewhere in the US. That causes some confusion. Of course, we still have some looming uncertainty out there surrounding tariffs, although it does seem like we're having more and more agreements, and it seems like the market, and generally speaking, we're more positively focused on the benefits from the One Big Beautiful Act, more so than the concerns around tariffs, but we're going to, of course, continue to monitor that closely. It leads us to our opportunities. As mentioned, we should be globally diversified, taking advantage of opportunities that we see across the globe, across equities, fixed income, and where appropriate, non-traditional assets, because we do think that they can provide that ballast to help offset volatility in your portfolio. So whether it's something like infrastructure, gold, or real assets, always something to consider and talk to your financial advisor. If it's something that you don't currently own already, there are ways to incorporate that in a very systematic, intelligent portfolio construct that you're not going to be overexposed, not necessarily trying to chase returns just because gold has done so well, but rather incorporate some protection into your portfolio that's going to offset some of the equity risk. And at the end of the day, we are strong believers that markets will go up over time. We're going to experience blips along the way, and yes, we could have another correction before year end, or I shouldn't say correction because some imply more than that, but just a downturn. But at the end of the day, we do believe that the markets are positioned accordingly. The markets are always efficient over the long run, and there's always an opportunity somewhere. So with that, we thank you for watching this Markets Monthly. Hope you found it insightful, and if you have any questions at all, please don't hesitate to reach out to your financial advisor. And of course, we're always happy to answer those questions. Thank you all. Have a great day.
Thank you.